Thanks, David. So a lot has really happened within tech broadly over this past year. And I think that there's a lot of kind of implications of that. But the high level things that we've noticed has been more liquidity, more competition within venture markets. And we think that that necessitates a need for better discipline overall. We've talked a lot about COVID, so we're not going to go down the whole COVID rabbit hole on what happened. But the high level really is that in March and April, we froze investments. We worked with our portfolio founders to figure out how should we reproject commercialization dynamics, how should we rethink financing plans. And I think the collective market was kind of scared at that time. It quickly rebounded, and what we've now saw is in Q3, the strongest third quarter in over 6 years in terms of venture financing. But as David mentioned, the thing that we do care about is thinking through, what are the futures we believe in, and in the categories that we invest in, what are the implications of something like COVID on our theses that we've built over time? And really what we saw was, things that we believed were going to happen over the next 2 to 3 to 4 years were massively accelerated. We saw that on healthcare and bio, on the regulatory and kind of economic side of things. We saw that on robotics and automation broadly, on labor, just how fragile companies realized they were based off of their labor forces, and a renewed interest in automation broadly. And then the last on this kind of more fuzzy digital living component, where on the enterprise side, we saw the addressable markets and kind of user bases of a lot of software products expand as everyone's workflow went digital. And then on the consumer side, just saw a massive uptake in usage as well as kind of new users and, again, addressable market expansion. But the thing that we really noticed is this idea of narratives proliferating throughout markets. And I think that is what has driven a lot of behavior over the past year. And we kind of have a view that private markets have always been dominated by narratives. Founders that are great at storytelling, great at buying into kind of getting people to buy into their futures, have a lower cost of capital. But as we started thinking about that, we tried to frame exactly what were the properties of those founders, what were they able to do, and we came up with this term of pseudo secrets, which essentially is a non-obvious narrative about kind of this next order effect within your business that allows your various stakeholders, whether it's employees, investors, potential customers, to really feel like they know a secret about your business, combat the doubters of your business, and also makes the future you believe in, despite it being potentially far away, feel closer to a reality. And I think, Uber is kind of a perfect example of that, which they used this narrative and these pseudo secrets of, it's everyone's private driver to no, it actually expands the market of ride sharing, to continue to expand their scope of ambition and use that to raise capital along the way to figure out the economics of actually their core business. And so we look at those as kind of TAM expansion narratives. But often within our companies, they're building deeply technical products. They sometimes have 2 to 3 years of R&D, and they really need to thread a needle towards kind of their ultimate future and navigate this kind of proverbial idea maze of every decision to make to unlock value. And we think, love him or hate him, Elon Musk is probably one of the people that has done that best, of figuring out what are the ways in which he can show a new step function of value over time and unlock capital to finance those. The interesting part is that usually this kind of sequencing narratives happened in private markets, and public market investors have always then said, okay, what are your economics? What's the business? Let's actually figure out the financials. I'd say Amazon is the only business that's ever been able to flip these dynamics in public markets historically, where they got kind of a pass from Wall Street saying, they're going to continue to expand their scope of ambition, and we're okay with them losing money for a decade plus. And that has now kind of changed within public markets. And so last year we showed you this slide, which was basically the major tech IPOs of 2019 and their performance. And what we surmised was that companies that had kind of strong technical moats, strong business economics, and were really in these kind of monopolistic type approaches were doing very well, where these more story-driven stocks were struggling a bit more. And I think that that's really interesting from a narrative perspective, because that's not what is happening today. And this quote from Eric Schmidt, which he said in April of 2020, I think signaled and kind of was a salvo shot in a lot of this thinking. In it, we're not going to read the whole thing, but he said, essentially, let's be a little bit grateful that these companies got the capital, did the investment, built the tools that we're using now, and have really helped us out. Imagine having the same reality of this pandemic without these tools. And I think just that framing of we should be grateful at the power these large platforms have really helped people understand, as well as the idea of them being behind a screen all day, helped them understand, what it is that, these tech companies impact on both our ability to work, our ability to live, and really how much impact they have on our day-to-day lives. And that pseudo secret of like the upside of technology has become common knowledge. It's led to arguably the most popular trade in all of US history, and at least in the past decade, of being long US tech, long US growth. But the thing is, people noticed this pseudo secret earlier and started acting on it. And so over the past few years, we've spent a lot of time talking about, different venture funds raising these mega funds. And a lot of people pointed to them and said they were kind of crazy and it was the sign of a bubble. And I think, if anything, this year has validated some of the views on the addressable markets and the views that these VCs had on the size of this opportunity. I think, Mark Andreessen in 2011 saying software is eating the world is far more prescient today than we even gave him credit for a couple of years ago. And as that is kind of rotated into public markets, we've seen both on the large platform side, obviously massive stock growth, as well as just on how people value these companies, on a forward-looking basis, has pretty materially changed. And some of that could be due to low interest rates, but I think a lot of it is this narrative proliferation throughout markets. And so as this understanding of like kind of long-term value of technology really opened the IPO window this year, it showed a lot of companies that were maybe afraid or were waiting for the right moment to go public, that now is the time. But the issue with tech, more than ever, is about the future. And IPOs really lack that future narrative. You can't give forward-looking statements, which is what gave rise to SPACs. Because SPACs enable us to tell stories of future value creation. And it allows company to paint that narrative with a sponsor that can kind of explain the pseudo secrets that they know to the rest of the market. And we think that deep tech is specifically well-positioned for SPACs because it allows sponsors to give social proof and explain companies that public markets often have had difficulty understanding because they're less comparable to other more mature industries or businesses. And in addition, there's often been a lack of consistent, true kind of pre-IPO capital for a lot of these deep tech companies, where you get to this point where you haven't scaled to your 50 to 100 million plus in recurring revenue that a public market investor would want, but some of the dynamics of your business are difficult to understand for a more traditional crossover investor. And I'd say lastly, as kind of has been in the news a lot, as retail investors have become more and more a key driver of markets, and that's the debatable statement, often investors have been looking for exposure to these kind of futuristic technologies, and they haven't been able to do it. They've done it through proxy investments like NVIDIA as a proxy for machine learning, or hoping that an R&D group within a large company creates enough value, like a Cruise within GM pre-spin out. So how does this all impact venture moving forward? We think that it creates deeper liquidity options and a bifurcation of stages, and there's a lot of kind of implications to how we then must operate. We've shown this slide for the past 2 years at our AGMs. And the kind of core take was that the IPOs of yesterday became growth rounds of today. Value creation broadly would happen within private markets versus the Salesforce, Googles, Amazons of the world that went public 5 or 6 years after funding. And we think that this still is true, but potentially there could be a subset of businesses where the scale of that value creation is actually not the same. Because if you look at the traditional IPOs from this year, you have really long times to going public. You have 17 years for Palantir, 16 years for Unity, and 13 for One Medical, and some are quickly. When you look at the SPACs, it's obviously a much faster time to liquidity. And the other thing that you might notice is kind of the valuations of these companies at the exit point. And so with less time in market to kind of accrue value to private markets, that changes a little bit the math that some venture investors must have. And I think our jobs as venture investors, specifically at the seed stage, is twofold. We form views on the futures that we believe in. We partner with founders to help realize those futures. And along the way, often as seed managers, it's kind of, we're along for the ride and we hope for the best. And I think that has long been, the statement of you're not better than the power law. Let these dynamics play out. Our view is the next stage of venture is actually about institutional grade fund managers having a different level of discipline. And that doesn't now just mean only kind of properly analyzing positioning or concentration or ownership or pro rata dynamics. But if we believe this time to IPO is going to fall, but this addressable markets and this value creation that could happen within technology is going to get larger and larger, we have to have a better understanding of when do we take liquidity, what is the ways in which we think about secondary markets versus holding stock post IPO. And I think that our jobs are actually going to look, partially a lot more like some of these later stage investors where that is kind of a core part of their jobs. But I'd say that's where a lot of, the comparisons between us end. So this mega fund behavior is not going away. These funds are going to continue to be raised. They're going to get bigger. And there's a bunch of reasonings for that. But, the high level is they see this opportunity and they're going to seize it. And so as venture is institutionalized more and more, this chart has gotten kind of more crowded with different specialized products. And even 5 years ago, it was great. We lived in a world where there was kind of pre-seed funds, and there were seed funds, and then there were these core Series A funds and growth funds that could write, slightly larger checks, and then these crossover investors, which would go to startups and say, we're going to Sherpa you through the public markets. We're going to invest $100 million pre-IPO and make sure that your IPO goes well, and we know how to run this process. But really, what I think we've seen is these parts of the stack are going to get just swallowed up by these conglomerates of funds and these core strategies. So for seed funds, we think pre-seed as a category is going to go away. We think it will still exist. There'll still be funds that tell that story, but seed funds like Compound are happy to move into pre-seed, right? 2 people and an idea, an early check, help them get going, and then meaningfully follow on and lead their seed round and build a position over time, recognizing that we want to deploy capital at these lower cost basis values. Where these full stack funds really are looking at kind of the first sign of product market fit and looking to plow in 50 to 100 to $200 million into their best companies. And there might still be a place for some of these crossover and growth funds, but I think it will continue to see more competition from the full stack funds. And so really what this kind of great bifurcation means is that we think venture as an asset class is going to be split into pre-product market fit and like early product market fit and on. Where on the pre-product market fit side, you're gonna have angels and seed investors and these pre-seed funds and scout programs, and even some full stack funds come in. And then, we specifically say early product market fit because if you have $1 million in ARR, $2 million in ARR, we see sometimes companies fetching anywhere from 100 to 300 times multiples on that at a valuation sense, because these investors are just looking for the smallest sign of traction to be able to write a bunch of call options and then plow money into their winners. And so what's a seed investor to do in all of this? Well, the good news is fund outcomes are getting bigger and fund returning outcomes are getting bigger. We, as David mentioned, are very strong believers that small seed funds are the best place for us to play. We think there is a lot of alpha and we think the opportunity is only getting bigger. And I think if you just look at the numbers, these fund returning outcomes for us, and we define that as kind of $500 million plus, just the universe of those is gone up materially over the past couple of years. There were over 400 $500 million plus outcomes in the past 3 years. For the 3 years prior to that, 2015 to 17, there were a little under 200. So the opportunity set has doubled. And yes, the counterpoint could be, well, valuations have gone up, there's more competition, and so your ownership is going to be weaker, and so 500 million turns into 750 million outcomes, and that's possible, but valuations at the early stage aren't actually scaling up as linearly or actually scaling up even, exponentially relative to some of the growth funds. And so we think that that is an opportunity for why seed is still interesting to us as an asset class. But there still is the problem, which is we're a small team, there's tons of companies starting, there's tons of competition, and there's just a lot of noise. There's a lot of noise if you're a VC, and there's a lot of noise if you're a founder. Who do you want to take your money from? And so how do we keep up? And the thing that we always talk about, that you guys hear about, that we're very serious about, is our approach to investing. And that approach can be summarized as research-centric, thesis-driven, but really we think of it as a flywheel that continually compounds upon itself, where we're identifying a thesis, sometimes doing years of work, really figuring out what are the types of businesses we think should exist within the different categories that we spend time on, establishing core brand network effects within those industries, and also kind of networks within those industries, and using that to meet founders, kind of continually update our views, making an investment, and then over time kind of scouting the frontier but defending the hill of the core areas that we spend time on. Because we think the best venture funds build their expertise in certain categories and exploit it for multiple funds as those categories mature. And we think about these kind of moments in time for some of these more emerging areas as inflection points. And we've written a lot about inflection points, looked at them for the past 2 decades. And we looked at them on an infrastructure level, on a distribution level, and even on kind of this technical level. And what we really saw was, we think that a lot of the more recent inflection points have been at the technical level, like the usage of GPUs and machine learning, or the falling cost of sequencing a genome for personalized medicine, and other things like that.